I'm Tom Stewart, the Executive Director of the National Center for the Middle Market at The Ohio State University Fisher College of Business, here to talk about the latest numbers from the Middle Market Indicator for the first quarter of 2019. The Middle Market Indicator, the MMI, is a pulse check for companies with annual revenues between $10 million a year and $1 billion a year. This is the middle market. These companies, about 200,000 of them, account for the middle third of private sector employment and GDP. And the numbers I'm about to share with you were collected in the first half of March 2019. When it comes to growth, the middle market turned in a terrific Q1 performance. Revenue rose on an annualized basis 8.7%. That's the second highest number that we have seen in the 8-year history of the MMI. The biggest winners were in business services, healthcare, and construction. Retail companies lagged a little bit. Also lagging a little bit compared to the market as a whole were companies with revenues between $10 million and $50 million a year, the smaller companies in the middle market. Those with sales between $50 million and $1 billion a year outperformed those smaller companies. But overall, across the board, it was a very, very strong revenue performance. You could give them a smiley button for it. Now, that rapid growth disguises a bit of weakness on the top line, however. 3 months ago, 73% of middle market companies said that their overall performance had improved in the previous year. This quarter, that number fell to 67%. That happened because a larger number of companies reported unchanged performance, 28% in this quarter, up from 22%. The number that dropped, the number down below, remained at 15%, where performance was unchanged. That was the same, but what you see is a larger number of companies here reported performance that had not improved. Didn't get worse, but it didn't improve. And so if you look at the growth numbers, you see this little bit of flattening out or thinning out of the percentage of companies that actually enjoyed superior growth. Well, now, let's look at jobs. The first quarter of 2019 was a really good quarter for employment as well. Indeed, companies increased their headcount by 5.6% on average, a very strong number and substantially above the jobs added by both small business or large business. Once again, the larger companies in the middle market outperformed the smaller companies, and the same three industries that showed very strong revenue growth, construction, healthcare, and business services, also showed very strong job growth. Incidentally, we also saw very good job increases in the manufacturing sector. A bit of a surprise, but middle market manufacturing has really thrived in the last couple of years. But with employment, as with revenue, we see a question mark inside the good numbers. The number of companies that said that they reduced staff is unchanged. It's 11%. It's about the same that it's been for the last 2 years. The percentage saying they've increased staff has tailed off. It's 51%, down from 55 and 57% in the previous 2 quarters. So it's the same pattern with jobs as we saw with revenue. More companies saying that they're staying the same, fewer companies increasing, but the same number of companies saying that employment is getting worse. Similarly, if you look at projections for employment growth in the middle market, 55% of companies, more than half, expect that their job headcount a year from now is going to be approximately the same as their headcount is now. That's the first time we've seen that number above a majority for several quarters. So we're seeing some thinning out again in the job growth picture. Now, in the case of jobs, executives are confronting a full employment economy, a more difficult environment for hiring than they would if there were lots of people who were unemployed. If I want to hire somebody, it means I have to take somebody away from a job she or he already has. That's the reason why, if you ask executives what their number one talent challenge is, they say retention, keeping the people we already have, because somebody else there is out there trying to poach them, and because it will be very hard to replace them if that somebody succeeds in taking employees away from me. So that's the job picture. A strong number, again, as with revenue, a little bit of thinning out in the number of companies that seem to be moving ahead, and an increase in the number of companies that are saying things are pretty much the same. Together, the revenue and jobs numbers suggest an overall softening of performance in the middle market. Still growing, but less uniformly and with reduced prospects for the future. If that's the case, it means that the middle market is delivering results that compare well to the forecasts that economists are saying, who are forecasting not a recession in the rest of the year, but growth that is going to be slower than the growth we've seen in the last 3 or 4 years. Indeed, middle market companies' confidence in the economy, the local economy, the national economy, and the global economy has dropped in each of the last 5 quarters. The confidence that we see in the local economy has gone like this. It's up at 88% of companies that are saying that they're pretty confident in the local economy. Similarly with the national economy, it's dropped a little bit in the last 3 quarters. It's now down to 80%. Still a very good number, but below what it was about a year ago. And confidence in the global economy, which has lagged, is down at 70%. Again, the last 3 quarters or 4 quarters, we're seeing a diminution in confidence in the economy. Now, that confidence is showing up in executive actions as well as in their sentiment. The low hiring projections may reflect that slightly diminished economic confidence. Another indicator is investment plans. Every quarter, we ask executives whether if they had an extra dollar, they would invest it or put it away, put it aside for future use. For the last 5 quarters, that number, that invested number, has been at 70% or higher. But this quarter, it dropped. It dropped to 65%. There's also a slight fall in the percentage of companies saying that they opened a new plant or facility last year, from 20% to 75%. Now, that drop in investment and that drop in investment confidence has been partly made up by an increase in spending and investment in R&D. And we're actually seeing that middle market companies are saying that they are going to devote 9.8% of revenue, a record high number, to research into new products and services that they'll be bringing to market. Now, these first quarter 2019 numbers are starting to raise a question. Are we beginning to see a divergence between companies that are performing really well and companies that are performing not as well as others? The numbers that I described, near record growth, accompanied by a diminishing number of companies that grew, high employment accompanied by an increasing number of companies that are saying they're not adding jobs. Those numbers only make sense if the winners are starting to skate away and open up some distance between them and the rest of the companies in the middle market. Now, if that's the case, the question is why? A year ago, we created a DNA of middle market growth, a growth model that, based on an analysis of 20,000 of data from 20,000 middle market companies, that identified the key factors that distinguish superior growth in mid-sized companies from others. Among those factors were market expansion, innovation and investment, attracting superior talent and developing that talent, and also managing more efficiently. Now, all 4 of those are factors that could be significantly affected by digital transformation. And one of the questions is whether we're actually seeing the impact of that on middle market companies, on some middle market companies. And it looks like that's what we might indeed be seeing. This quarter, we asked executives, as part of an ongoing study of digital transformation, we asked executives how much they agree with the following statement. Quote, "Our organization's digital vision is clear and comprehensive, widely understood, and used to guide strategic decisions." Companies where executives agreed or strongly agreed with that statement grew at a rate of 10.6% in the last 12 months. The other companies where they disagreed or were neutral about that statement grew at 6%, more than 4 points of difference in growth. These companies also added more jobs than the digital laggards or the digitally neutral companies. So we're beginning to see that this gap that's opening up between the top performing growth champions in the middle market and the rest of the middle market may indeed be caused by the degree to which they are applying digital tools and digital ideas and digital techniques to all aspects of their business, from the back office to the way they deliver and produce goods, to the goods and services, and to the way they interact with customers in marketing, sales, and so on. So that's the story from the middle market. What we seem to be seeing is a burst of growth from the most digitally sophisticated companies in an environment of very strong top-line growth, continued strong employment, but also increasing questions about the ongoing strength of the economy and a little bit of caution as executives look forward to the year ahead to figure out how much money they're actually going to invest and whether they want to make sure that they size their investments to the size of the economy and the size of the business opportunities that face them. Now, that's the story from the middle market. You can learn more about the middle market, learn more about the National Center for the Middle Market, and see all of the data behind the Middle Market Indicator at our website, middlemarketcenter.org.